So your new company is making a profit. Well, that's pretty cool. But how do you get that money out of your company's bank account and into your personal bank account so you can pay your mortgage and buy your coffee? If you take it all, will inland revenue come knocking? If you leave it all, how do you eat? And what on earth is a drawing anyway? Today, I'll show you a plain English introductory guide to the 3 ways Kiwi company owners pay themselves and some common tax traps. I live and breathe this stuff, but I'm only going to be scratching the surface. So if you want to know more, leave a comment, send me an email, and I'll get back to you. For company owners, there's only really 3 options to choose from. Pay yourself a PAYE salary, take drawings, or use a combination of both. With a PAYE salary, you pay yourself exactly the same way you would any other employee. You register a payroll account with Inland Revenue, you file payroll information every payday, you pay yourself an after-tax wage into your personal account, and pay payroll tax and any other deductions to Inland Revenue every month. The benefits of this is that it's straightforward and consistent. The drawbacks are that you have to file returns every pay run. If the cash flow of the business is inconsistent, then the company might not have enough cash to pay you, and you can get some funky tax outcomes, especially if the salary you set for yourself is higher than the profit the company makes. Drawings are simply transferring money from the business to yourself. At the end of the year, your accountant declares you a shareholder's salary to cover what you've drawn, plus a few other technical considerations. The benefits of taking drawings is that it will probably be the most tax efficient option, and you can easily adjust the amount you draw based on the cash flow of the business and your personal needs. The drawbacks are that you'll need to set aside money for tax since it's not being paid as you go. And there's a trap you can fall into, which is if you draw more than the business makes in profit, then you'll find yourself owing the business money, which has some bad tax consequences. Using a combination of both means that you pay yourself a PAYE salary, but you set it to what you know the business can sustain and then top up with drawings as the business allows. So, let's see some common examples and the tax outcomes. Let's use a nice round number. Let's say that your business earns 100k of profit before tax and your pay in a year. If you're using the drawings method, then you'll have taken out cash as you've gone. And since you're a good business owner, you've also set aside between 25% and 40% for tax and ACC in a separate interest-bearing bank account, depending on how profitable and conservative you are. When we do your financial statements and tax returns at the end of the year, we allocate you some or all of the company's profits, depending on quite a few technical factors, as well as considering the tax outcomes. If you've got a crystal ball and managed to pay yourself a PAYE salary of exactly 100k, then you'll have paid the 22,900 in PAYE plus other payroll deductions. If you don't have a crystal ball, you might have set yourself up to pay 80k or 120k in PAYE. What happens then? The 80k scenario is essentially the combination method. There's 20k of taxable profit left over, and you'll have paid 16,300 of PAYE plus other payroll deductions. The 20k could be kept in the company's retained earnings, meaning it'll be taxed at the flat company tax rate of 28%, which is another $5,600. That means that the tax expense between you and the company for the year would be $21,900, a full $1,000 less than the PAYE salary option. What about the 120,000 scenario? Now there's 20,000 of losses, which are carried forward to be applied against the future profits. But you've already paid PAYE of 29,500 plus other payroll deductions. It's starting to get quite complicated because on the face of it, the 80k scenario has the best tax outcome. So you should just pick that one, right? Well, not necessarily. The retained earnings will eventually need to be paid out as a dividend. Dividends are taxable income for the shareholder. So if your marginal tax rate is above the company's 28% flat tax rate in the tax year that the dividend is declared, then you'll need to top up the difference in tax. So this can actually end up being the least tax efficient outcome of the 3 scenarios if your marginal tax rate is 39%, because you'd have to top up the 11% difference between your 39% tax rate and the company's 28% tax rate. This is actually a really sneaky trap that I've seen a lot of accountants get wrong with their clients. They let the retained earnings of a company build up and up and up over the years, thinking that they're giving their client a tax-efficient shareholder salary between $53,500 and $180,000, leaving the rest of the profit to be taxed in the company at 28%. But they're unwittingly creating a ticking time bomb of one big dividend that will be taxed at 39%, instead of having the client pay tax at 30 or 33% as the profit is made. Compounding this mistake is that the client often spends the cash as it's earned. So when it comes time to do a wind-up dividend, the client doesn't have the money to pay the top-up 11%. This might be you if you've been in business for a while. Take a look at your retained earnings figure in your last set of financial statements. If it's above 100,000, you might be in for a nasty tax surprise when you come to wind up the company. At the end of the day, choosing a payment method that works is unique to you and your company. So if you've got an accounting question, leave a comment, send me an email, and I'll get back to you.